Hey everyone, wherever you are, hope you're having a wonderful week so far. We're here with the latest episode of the Inside Crypto Show, interviews and discussion with regular people just like yourselves. Today we're joined by Charlie Mars, the Chief Investment Officer of ByteTree Asset Management, founder, manager, and editor of the ByteTree Multi-Asset Investor. He's the founder and chairman of ByteTree.com, an investment research, data, and asset management business. Charlie also writes the Multi-Asset Investor on ByteTree.com, which is the continuation of the Fleet Street letter, which he wrote from 2016 to 2022. Charlie, that's a lot that I just explained. Is there anything else you want to talk about yourself? So introduce yourself a bit more.
Sure. I'm 25 years a fund manager. So before that, 17 years at HSBC Global Asset Management. I'm running a $3 billion multi-asset book. I followed gold since the late 90s. And when Bitcoin came along, I just went, wow, that's interesting. So that's how I got here.
Oh, very nice. And Charlie, why did you decide to move from HSBC into ByteTree Management? That's one of the stories I tried to research on my own, but I couldn't find like a clear answer to that.
So I left HSBC in 2015. Life after the credit crisis was very different in a firm like that. Active managers were very widely sought after pre-2008. And after 2008, the world opened up to index funds and long-term 60-40 type strategies. People like me were seen as dinosaurs. And the opportunity was behind me. So I said, where can I continue to do what I do? Make active investment decisions. And by the way, I'm pretty good at it. I've been doing it a long time. And as an independent was the best place. So that really, I founded my own company, ByteTree, and that's where we do it today.
Fantastic. And so much information about ByteTree. For anyone listening or you're watching on YouTube, all the information about ByteTree and the stuff we're going to talk about today will be in the show notes. Before we get into that, I just want to remind everybody, anything Charlie says or I say or questions I ask or questions Charlie asks is not financial advice or to be construed as such, right? This is just our individual opinions and not to be connected with our respective organizations. Charlie, we're going to talk about something really exciting today. We've thrown the script out. We're talking about Bold. And besides being an awesome name, it's also a really cool product, Bitcoin and gold, right? With ByteTree and the 21 shares. Do you want to give some listeners and viewers an overview of what this actually is before we talk about the details?
Okay, so we know what gold is, don't we? We wear it, it looks lovely, it's really heavy, it's hard to forge. That hard to forge thing is quite important because it's got a density of, 19.3, I think. And so it's 19.3 times heavier than water. And you can't fake that. So if you go back a couple of thousand years and you're trading in Shanghai and you're trading in Amsterdam or something, that unit of value is the same in the other side of the world without communications. Gold is the original fintech in that sense. And it's a very powerful idea. And I think people should see it that way. And Bitcoin went, well, that's a good idea. Satoshi Nakamoto liked the idea of gold, limited supply and hard to forge and these things. Why don't we just make it 21st century so you can move it around more easily and that sort of thing? Blockchain comes along and there's Bitcoin. So these two assets do have something in common. Obviously, gold's much more established. It's much bigger. We're talking about a $13-14 trillion asset, whereas all of crypto is 1 trillion and Bitcoin's 40% of that. One's up and coming, the other's established. But nevertheless, they both reach for the same objective. They're liquid alternative assets. Gold is very much part of the financial system in an informal way. So before 1971, it was a formal part of the global financial system. Yeah, and all the currencies were pegged to the gold price in some way or another. That broke down in 97-1, partly for tech reasons, partly because you could now have a fiat system because modern communications, data, telephony, all of these things were good enough now for a fiat monetary system to have live moving exchange rates. Whereas back in the day, you couldn't do that. You couldn't do that with Pigeon Post. And so technology is an important part of the evolution of the gold Bitcoin story. They've both been at the forefront of tech at some point in their history. And there's a sort of challenge on who's the alternative liquid asset of the future. And there's a need for an alternative liquid asset. And so it was my simple idea that we should bring these assets together. And that's really what Bold is.
Very cool. You mentioned this earlier, and we talked about it being Bold being 80% gold, 20% Bitcoin. For some people, right, they might be listening to this and looking up on the ByteTree website. Was there a reason for this particular allocation?
Yes, so I wanted to design Bold so the market decided what the allocation was. And what we do is we look at the volatility over the previous 360 days, which is basically a year. And what we want to do is say, I want to put more money into the most stable asset. And it so happens that Bitcoin's volatility has been around 55% over the last year, and gold's been around 15%. It's that kind of thing. And if you do a bit of simple financial maths, which are on our website, which are too boring to talk about, Korean, but it's on the website for those who are really geeky. And the bottom line is that if the volatility was the same, it would be a 50-50 relationship. So if both gold and Bitcoin had 30% volatility or 10%, it wouldn't matter. It would be a 50-50% allocation. But when we talk about 80-20, it's actually about 80-20. It's about 81-79 at the moment. And we've got more money in gold and less money in Bitcoin, but we've got the same amount of risk in each asset. And that's the key bit. So if Bitcoin was going to go down 10%, you would hope that gold would go up 2% and offset, and so gold would remain flat. And the basis of these two things, these two assets have what we call low correlation. So if you said to me, Bitcoin's going to double, what is gold going to do? I'm going to say, I don't know, because gold has low correlation to Bitcoin. But if you said Bitcoin's going to double, what's Ethereum going to do? I'd say it's probably going to double, or it's probably going to double and a bit more, something like that. It's not a stupid answer, is it? It's going to be pretty similar. But with gold, I have no idea how it's going to behave if you tell me what Bitcoin's going to do, because it's got low correlation. It might go down, it might go up a bit, it might do nothing. So that's an advantage when we're trying to diversify the two assets. And it's very rare that you find two assets with such low correlation as Bitcoin and gold. And the second point is they've got a thing called high dispersion, which means if you go month by month, how different were their moves? The answer is very different. So if you look at the difference between what gold and Bitcoin do on a casual basis over a period of time, it's always different. Whereas if you take French and German equities, or Bitcoin and ETH, or gold and silver, the moves are always very similar. So we've got low correlation, high dispersion, and we're risk weighting the assets. So we've got the same amount of risk in each, which is different from the same amount of value in each.
Very good answer, and very to the point as well. Charlie, people looking at this product, okay, this sounds interesting, but I want 100% gold, or I want 100% Bitcoin. I want better allocations. And if you explained why this allocation works so well, then if they're like, okay, I understand the allocation now, who is this product for? Is this for mom and dad in their 60s? Is this for retail? Is this for institutions? Is this for everybody?
I think it's for everybody, but obviously it's going to be of most appeal to people searching for alternative investments. Some people don't want alternative investments. So if you don't get gold, you don't get Bitcoin, there's no need to own this. But if you do get alternative investments, then I believe that gold is a superior answer to either Bitcoin or gold on a risk-adjusted basis. That's not saying that gold's going to make the most money. I'm saying that there's a lot of unknowns in the next 5 or 10 years. And the outcome from gold in 99 out of 100 scenarios is going to be superior to both of the others. If you own Bitcoin and gold over the last 5 years, in gold you made a little bit of money, about 30 or 40%. In Bitcoin you made a similar amount. And don't forget the high was in December 17, so we're now at mid-January 18 starting point on the past 5 years. But gold is ahead of both Bitcoin and gold by about 6% a year. Why? Because of rebalancing transactions. Because what I said a moment ago, there was low correlation, high dispersion. If you're always selling the one that did better each month and buying the one that did worse, then you end up making a little bit of money over time. And that's about 6%. The magic of the Bitcoin gold combination is not just owning both assets, it's owning both and rebalancing on a frequent basis. And that's where you get the best out of gold. And so I think anyone who wants to own gold should say, actually, I can enhance my gold with a bit of Bitcoin. And anyone who wants to own Bitcoin say, my God, I can reduce the risk massively by owning some gold. And you just see the experience in recent years. There seems to be some 4-year cycle in Bitcoin. Gold's not a barbarous relic. It's real. And China are buying it today. These things are both relevant and increasingly more relevant as the credible alternative assets, credible liquid alternative assets become more and more in demand structurally.
Since you mentioned alternative assets, and I've seen that sort of mentioned as a narrative in the last 3 to 4 months or so, for people who don't know, like, what are alternative assets and why are they in demand?
So an alternative asset is not a formal asset. It's an informal asset that's off grid. And a classic formal asset would be a sort of a US dollar or a Japanese yen or a Chinese renminbi. These are all attached to governments. Now, those currencies also have bonds, and those bonds are a massive market. And they are very much controlled by their respective governments. And then anything that's bolted down within a country, like shares or real estate, to some extent is controlled by governments. But obviously there's a free market element to it as well in most countries. An alternative asset is completely independent from a government. The government has no influence on gold, and it has no influence on Bitcoin. You'd have to get many governments to agree to a system in order to control it. And indeed, we tried that pre-71 with gold. So in 1971, we did have a system where they tried to control gold. It broke down, and gold's now a free alternative asset. And the same is true with Bitcoin. I mean, you can control in and out of Bitcoin. You can control the nodes in your country of how you interact with the Bitcoin network, but you can't control the network itself. It's like oxygen. It's just out there. You can't tell the birds where to fly. The network is just doing its thing, and it's truly independent and autonomous. So that's what we mean. Now, we said liquid. So what else is an alternative asset? An alternative asset could be a painting, it could be a classic car, it could be a collectible of some kind. Many people say, how about commodities? And I say, fine. Most commodities you can't practically own as an asset because of storage concerns. Yeah. I mean, oil and agriculture, you need vast amounts of space, and they might wear. So you end up with futures contracts, which kind of aren't an asset. In the long term, they're not. In the short term, they are. And art and things, they're just not liquid. See, when you boil it down, you realize that the two most liquid alternative assets in the world are gold and Bitcoin. Bitcoin is 3 times more liquid than silver, which comes in third place, if you exclude oil, because it's futures only.
Yes.
And there you have it. We're combining the world's 2 most liquid alternative assets in a way that gives you a better outcome than owning each one of them independently.
That's very true. And you make really good points about commodities, because I know, especially from the retail side, it's like people talk about, yeah, you can make money in commodities if you do some trading, but it's not accessible to most people. But like you said, Bitcoin and gold is something far more accessible, far easier to understand, I would even say, than futures contracts or just generally trading commodities.
Just on the commodities, I'll give you an example, and I haven't got the numbers at the top of my head. For example, if you've owned an oil ETF in the USA, I think the ticker's USO, I think. And underperformance over spot crude oil over the last 10, 15 years has been massive because you have this negative roll yield. It's not the product provider's fault. It's not the fees. It's this natural state of affairs in the oil market. And it's called, in commodities, they call it contango. And there's a negative roll yield. This is all financial jargon. But it basically means if you own an ETF of a typical futures-based commodity, you will lag the spot price significantly over long periods of time.
Oh, okay.
Now, in Bitcoin and gold, you can own them physically, so you don't have this problem. And indeed, 21 shares, that's what you do.
Yes, exactly. Okay. One of the things, like in researching this show, I was looking at your Twitter, and I know somebody was like, Charlie, man, Bitcoin is terrible. How do we get people out of that mindset of saying, you know what, this Bitcoin is not terrible, and Bitcoin is only 20% part of bold. So even if you don't like Bitcoin, this is still a good idea.
Yeah, so look, why are people so skeptical on Bitcoin? It's because it's very easy to win the Ponzi pyramid scheme argument, because there's nothing. Let's look at that. Firstly, I want to talk about Ponzi schemes. Now, if you wanted to have a Ponzi scheme, you would generally have very low volatility. Yeah. So if you think about all the stablecoin crises in crypto, or you think about Madoff, or all the frauds that have happened in history, there's basically been no volatility or very low volatility. Madoff had this price that just steadily went up. There's never in history been a Ponzi scheme where they've got high volatility in your face. Yeah. Bitcoin has never tried to hide volatility. It said, look at me, I'm risky. I'm interesting, but I'm risky. And a Ponzi scheme is trying to disguise risk. So I think that those people who say crypto's Ponzi, they just don't understand what Ponzi is. They're completely missing the elephant in the room. But those criticisms are so easy. If you don't want Bitcoin to succeed, it's very easy to believe those arguments and want to believe those arguments. I think that, what I say to people, particularly people over 60 who work in finance, who just don't get it, I say to them, Bitcoin has got no intrinsic value. And they go, yes, it's got no intrinsic value. I say, well, of course it hasn't got intrinsic value. My Twitter account doesn't have intrinsic value. Yeah, but it has a network value. I've got 6,000 followers on Twitter. It's taken me years to accumulate them. I wish I had 60,000, but obviously I'm not interesting enough. To me, there's a huge network value there. Yeah, even though there's no intrinsic value. And Bitcoin's the same. So what did Warren Buffett famously say? He said, I wouldn't pay $25 for all the Bitcoins. Yeah. Now, if you did buy all the Bitcoins, you would have no money. Because if you owned all the Bitcoins, it's a bit like owning all the telephones, and you've got no one to call. You've got no one to transact with. You've destroyed the network. The most important piece of the whole equation is the ability to transact in a liquid network. So the Bitcoin itself is not the value. It's the part of the network. It's the part ownership of the network that's the value. And so people just need to get past the idea that it's not a fraud, it's not a Ponzi scheme. All the risk is in your face. It's shown to you, it's demonstrated, there it is. Nothing is hidden. And there's a huge amount of transparency on the blockchain. But it's not the intrinsic value we're looking for. We do that with pianos and cars and paintings. Do paintings have intrinsic value? Or do they have appeal? What's the debate? But it's this network. And we know the networks are valuable because we've seen WhatsApp change hands many years ago for $18 billion. We thought Zuckerberg was crazy when he did it, but he was right. And then we seen social media take off and all these things, and all of them have multi-billion-dollar valuations. And we no longer blink. We say, you've got the world's attention. The internet gets the world's attention. And anything that gets the world's attention and has use is valuable. So we're on this journey, and blockchain's useful, and it's changing the world, and it's going to end up doing something very impressive. We're not quite sure what those things are, but right now, Bitcoin is a little challenger to the gold market.
To somebody listening to this podcast, Charlie, and they're like, okay, I'm really interested. We did another podcast last week. We spoke to another sort of personal finance investment guru, quote unquote guru, but his suggestion was 5 to 15% of your net worth in instruments like gold, in crypto, that sort of stuff. Is like, where does this sit in somebody's portfolio?
Okay, that's a really good question, Korean, because let's start with the textbooks and we'll work from there rather than just me making it up. So most people are saying 60-40, right? That's the traditional thing in finance. You have 60% in equities and 40% in bonds. Now, if you're American, that means 60% of the S&P 500 and 40% in US treasuries. And you would normally translate that to other countries as having the bonds in your own currency and the equities, depending where you are, provided your country's got a decent stock market, you would use that. If it didn't, then you would probably increase the international allocation. But so that's the basis. And if you go to the World Gold Council and say, what do you think about gold, World Gold Council? Now, obviously they like it because it's their job to like it, but they have commissioned various papers, and those papers have concluded that a 60-40 over time has got a slightly better return and slightly less risk by having 8% in gold. And I would say that gold should be funded by bonds rather than equities. And the reason I say that is because gold behaves like an inflation-linked bond. Okay, technical conversation. We could probably come back to another time if you want to get me back on your show ever, Korean. But so we've now got a 32, 8, 60. So 32 in bonds, 8 in gold, and 60 in equities. Then I did my research on gold, and as you said earlier, 80-20. So if we've got 8 in gold, then maybe we should have 2 in Bitcoin. And that makes perfect sense. And that Bitcoin, because it's more correlated with equities than it did with bonds, then that should come out of equity. So we've now got a 32 bonds, 8 in gold, 58 in equities, and then we've got 2 in Bitcoin. Fine. And then the final bit is, what about the rest of crypto, Ethereum and all that stuff? And you go, okay, correlated with Bitcoin, but it's got some sort of utility. It's trying to build something new on the internet, Web3, or a new financial system, or what have you. And so really, it's technology, isn't it? So it's going to have more in common with our tech stocks than with our Bitcoin, which we're kind of thinking is an alternative monetary asset. And so I'll probably put a couple of % in there and take it from tech. So I would say the answer to that question, and this is a good answer, justified by academic research, is a 60-40 should become a 32 bonds, 8 in gold, 56 in equities, with 2 in Bitcoin and 2 in the rest of crypto. And that is not that dangerous. If crypto wants to go down a lot in a bad year like it did last year, fine. But that's no worse than what stocks will do. And if it wants to go up a lot, well, great, you're going to have a really good year. Your 4% could very easily go up 5 times or something. You can have a very nice year. And I think on average over time, that will do a really good job. And my idea of a 60-40 with a space for gold, a little bit of crypto, is going to do better than a traditional 60-40 over the years. I have no doubt about that.
I definitely have no doubt, because that sounds like, I think I've asked this question not too many times, maybe 5 times in the last 1 year. And this is the best answer I've ever heard. The most logically explained as well, Charlie. So I really appreciate it. Charlie, I was told not to take up too much of your time, so I don't want to keep you too long. Is there anything else you'd like to end off with on gold, Bitcoin, ByteTree? You have a lot of stuff on your Twitter, so I'm going to be putting that in today's podcast and video. So if people want to go back and listen to some of the very smart things you say, they can go and do that. Anything else you want to end off today's show on?
I'm really grateful for the time, Korean. I think that the gold Bitcoin conversation is massively misunderstood. A lot of people in Bitcoin think gold's the enemy and we're trying to fight, Bitcoin's trying to overtake that one. A lot of people in gold just think Bitcoin is ridiculous and shouldn't be here. I'm very much at the center of saying there are two interesting assets and they've got a natural place together. I don't think that gold's ever going to become irrelevant, and I don't see any reason why Bitcoin should become irrelevant either. I think they both survive long term and they'll find their place, which will be different. They don't need to be the same. There's a pros and cons to both. One of the great advantages of gold over Bitcoin is it doesn't need any electricity. And once you've got it, it just sits there. So yes, but an advantage of Bitcoin over gold is you can stick it down the phone lines and move it instantly around the world. Of course, but some of these things, sometimes a disadvantage can be an advantage in other areas. And I think people would just have a sort of more rational conversation about the combination. And I can't wait for the day when I'm no longer talking about gold, but other people are talking about gold.
Fingers crossed. One last question, just because I wish I didn't live in Taiwan, because then I could have access to gold. But are there any other interesting products that are in your mind that might be coming later on in the year with like this cool 2080 gold configuration?
In crypto, we do at ByteTree, one of the things we do is called Bytefolio. And we basically are trying to do an optimized portfolio of crypto. And we launched it last April. It's a model portfolio, it's on paper. And we started with 10 Bitcoin. We've now got 9.7 Bitcoin. So it's down 3% in Bitcoin terms. So not a huge success in our first 8 months, but we think our process is very strong. And I think most crypto baskets have underperformed Bitcoin last year anyway. So that would be a pretty normal experience. In fact, quite a good experience, frankly. And we're just trying to make sure that we can identify the best crypto projects and avoid the bad ones, the failures, and try and get some kind of optimized basket. So that's something we are trying to do. Is there a product on the horizon? Not yet, but yeah, I'm sure 21 shares will be the front of the queue when there is.
Thank you very much, Charlie, and I appreciate it. Thank you again for your time and making time. I would imagine it's just before lunchtime out there in England. And I hope you have a good rest of your day. And hopefully, yes, I'm definitely going to speak to the powers that be and see if we can do this again, maybe in another month or another 2 months.
Fabulous. Thanks, Graham.
Thank you, Charlie.